Welcome to StockTok's deep dive into Cintas Corporation. Cintas is the largest provider of corporate uniform and workwear rental services in North America, with additional offerings in facility services and safety products. At the time of recording, shares are trading at 179.17, sitting closer to their 52-week low of 165.6 than to the 52-week high of 229.24. The RSI, or Relative Strength Index, a momentum gauge where 50 is neutral, reads 49.9, essentially flat, with no directional conviction. The 50-day moving average at 187.71 sits above the 200-day moving average of 195.8, a technically bearish configuration that reflects the stock's broader pullback from its highs. Let's work through the fundamentals, scene by scene. Starting with a quick business overview. Cintas generates revenue through long-term contracts to supply, launder, and manage uniforms and workwear for businesses across virtually every industry vertical. That recurring contract structure creates significant switching costs and predictable cash flows. The StockTok score sits at 48 out of 100, a caution rating. The 5 dimensions break down as follows. Valuation scores 0 out of 20, financial health scores 16 out of 20, profitability scores 19 out of 20, growth scores 11 out of 20, and smart money scores just 2 out of 20. Now, valuation. The question every investor has to answer: are you paying the right price? At the time of recording, Cintas trades at a trailing price-to-earnings ratio of 37.8 times, meaning investors are paying nearly $38 for every $1 of earnings the company generates today. The forward price-to-earnings ratio, which uses consensus earnings estimates for the coming year, drops to 32.98 times, implying some earnings growth is already embedded in the price. The PEG ratio, which divides the price-to-earnings multiple by the expected growth rate to assess whether the valuation is justified by growth, stands at 2.68. A PEG above 2 is generally considered elevated, suggesting the market may be pricing in a fairly optimistic growth scenario. The EV to EBITDA ratio, enterprise value divided by earnings before interest, taxes, depreciation and amortization, a capital structure neutral profitability multiple, reads 24.44 times, which is meaningfully above the roughly 15 to 18 times range that diversified business services peers have historically commanded. In our view, the economic moat here is genuine. Cintas benefits from deep switching costs, route density advantages, and strong brand recognition in a fragmented market. That quality premium is real. The Guru Focus Value, an intrinsic value estimate, sits at 205.70. At the time of recording, the stock trades at a 12.9% discount to that figure, suggesting a modest margin of safety relative to that model. Wall Street analysts at the time of recording have a consensus mean target of 212 across 17 analysts, with a high target of 255 and a low of 160. Market sentiment around Cintas, as of the creation of this video, is essentially neutral, with insufficient recent news flow to shift that reading in either direction. Overall, in our view, valuation remains the clearest constraint in the setup, which explains the 0 out of 20 score on that dimension. Moving to financial strength, how solid is the foundation? The Piotrowski F-score, a 9-point checklist that evaluates profitability signals, leverage trends, and operating efficiency, comes in at 8 out of 9. That is an exceptionally strong reading, only 1 point away from a perfect score, indicating that nearly every financial health indicator is trending in the right direction. The Altman Z-score, a multi-factor model originally designed to assess bankruptcy probability, where scores above 3 are considered safe, registers at 11.75. That is almost 4 times the safe zone threshold, which tells us financial distress is essentially a non-issue here. On the debt side, the cash-to-debt ratio is just 0.06, meaning Cintas carries relatively modest cash against its debt load. However, that concern is substantially offset by an interest coverage ratio of 24.22 times, meaning the company generates over $24 of operating income for every $1 of interest expense owed. That is the coverage of a business with very strong debt service capacity. The current ratio of 1.98, current assets divided by current liabilities, shows comfortable near-term liquidity. Debt to equity of 0.61 is moderate and well managed. The verdict here is clear. This is a financially healthy, well-capitalized business with very low credit risk. Next up, profitability. Is this business actually making money efficiently? We lead with return on invested capital, which measures how much profit the company generates for every dollar of capital it has deployed. And at 23.69%, Cintas is delivering returns that are well above the cost of capital for virtually any company. That is the hallmark of a business with genuine competitive advantage and pricing discipline. Working down the margin stack, gross margin, the percentage of revenue retained after direct costs of service, stands at 50.36%. For a business built on physical logistics and labor, that is a remarkably clean gross margin and reflects the locked-in, recurring contract revenue model. Operating margin, which accounts for overhead and administrative costs, comes in at 22.95%, an extremely efficient cost structure for a services business of this scale. Net margin, the bottom line profit after all costs including interest and taxes, registers at 17.57%. And free cash flow margin, the percentage of revenue that converts into actual cash available to shareholders or for reinvestment, is 16.27%. That conversion rate demonstrates that earnings quality here is high. The company is not just booking profits, it is collecting them in cash. The profitability score of 19 out of 20 reflects all of this, and in our view, Cintas is among the most consistently profitable businesses in the industrial sector. Onto growth. Is this business expanding? And at what rate? Over the trailing 3 years, Cintas has grown revenue at 9.6% annually, a solid, consistent rate for an industrials business operating at this scale and maturity. Stretching the window to the trailing 5 years, the compounded revenue growth rate holds at 9.8%, remarkably stable, which tells us this is not a business prone to cyclical whipsaws or lumpy contract wins. That consistency is a feature, not a coincidence. The recurring contract model smooths revenue in ways that project-based or transactional businesses simply cannot replicate. Book value per share growth over the trailing 3 years comes in at 12.7% annually, book value being the net asset value of the business on a per-share basis, which suggests that value is genuinely being created and retained, not just distributed. The dividend yield at the time of recording stands at 0.97%, just under 1%. That is a modest income component, but Cintas has a long track record of consistent dividend growth, and the payout is well covered by its free cash flow margin. The growth score of 11 out of 20 reflects the fact that while the trajectory is healthy and consistent, it does not reflect the kind of accelerating or above-market growth rates that command a premium multiple. Based on what we see, the growth profile here is steady and durable rather than explosive. Now let's talk smart money. What institutional capital is actually doing with this name? 9 top-tier investment managers, or gurus as tracked by institutional ownership databases, currently hold Cintas in their portfolios. That is a meaningful signal of long-term conviction from sophisticated capital allocators who typically conduct deep fundamental analysis before establishing positions. However, the directional picture is more cautious. Only 7.5% of 13F institutional filers, the quarterly filings that large investment managers are required to submit to regulators disclosing their equity holdings, are classified as net buyers of Cintas at the time of recording. The threshold for a broadly bullish institutional posture is typically above 50%, so 7.5% is a notably low reading and a meaningful headwind signal. Insider ownership stands at 0.81%, meaning company management and board members collectively own less than 1% of shares outstanding. That is a low figure, and in our experience, It reduces the alignment of interest between executives and external shareholders. Perhaps more telling, over the trailing 3 months, there have been 0 insider purchases and 0 insider sales. Complete silence from insiders can be interpreted multiple ways, but combined with the low ownership base and the weak 13F buying rate, the overall smart money picture warrants caution, in our opinion. The smart money score of 2 out of 20 reflects this lack of institutional enthusiasm at current price levels. And finally, the verdict. Let's bring it all together. On valuation, the data suggests Cintas is trading at a premium multiple relative to its growth rate, and while the Guru Focus Value model indicates a modest discount to intrinsic value, the PEG ratio and EV to EBITDA both point to a setup where a great deal of good news is already priced in. On financial strength, this is one of the cleaner balance sheets we see in the industrial space. Piotrowski at 8 of 9, and an Altman Z-score nearly 4 times the safe threshold leave very little room for concern. On profitability, 19 out of 20 is not a score you come across often. The margin structure and return on invested capital of this business are genuinely elite, reflecting a durable competitive moat built on switching costs and operational scale. On growth, steady and consistent but not accelerating, the 9 to 10% revenue growth profile is attractive for a mature business, though it does not fully justify the current premium multiple in our view. On smart money, the weak 13F buyer rate and minimal insider ownership create a less than compelling positioning signal at current levels, and we would want to see broader institutional accumulation before interpreting this as a high-conviction entry point. Overall, the thesis on Cintas is that of an exceptional business trading at a full price, the quality is undeniable, but the setup, based on what we see, warrants patience rather than urgency. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Cintas Corporation. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.